The next learning objective is to perform a vertical analysis of financial statements. So notice here we have an income statement, but this time just one. So we're going to be analyzing this vertically. So for the income statement, everything is going to be based on a percentage of revenues. So vertical analysis shows relationship of each item to a base amount on the financial statement. And the base amount for the income statement is going to be revenues. Notice revenue is 100% of itself. So what this amount down here means, 12.5%, is that net income is 12.5% of revenue. How did we calculate that? We took 399 divided by 3,189, which is revenues, and then multiplied by 100 to convert it to a percentage. So in our example, how much of revenue ends up as profit? Well, 12.5%. What this means is for every dollar of revenue, 12.5% of that dollar turns out to be profit. And what is 12.5% of a dollar of revenue? It's 12.5 cents. So this 12.5% means that for every dollar of revenue, the company has 12.5 cents of profit. Looking at some of the other numbers, income tax expense, $251, is 7.9% of revenue. So that's saying 7.9 cents per dollar of revenue goes towards paying income tax expense for this company. Gross profit for this company is 54.3% of revenue. What that means is for every dollar of revenue, 54.3 cents is gross profit. Now remember, the formula for gross profit is revenues minus cost of goods sold. In this case, the company called it cost of revenues, but it's usually called cost of goods sold. Now we're looking at a balance sheet. So when we do vertical analysis for a balance sheet, once again, there's only one balance sheet, so we're not comparing year to year. So we're comparing everything to total assets. Notice we can tell this because total assets is the number that is 100%. So to get this 12.9%, we took cash and cash equivalents, $427, divided by total assets, 3,313. Multiply by 100 and you get 12.9%. What this means is that 12.9% of assets are cash and cash equivalents. Now, if you understand the accounting equation, which is total assets equals total liabilities plus owner's equity, the base amount is also total liabilities and equity because it is the same as total assets. So let's try to analyze this company a little bit. Suppose the average company has current assets of 30% of total assets. So the average company has, instead of 81%, has 30%. So how does this company compare? Well, this means 81.3% of this company's assets are current assets. Well, what does that mean? Well, current assets are liquid assets. So that means that this company has lots of liquidity. Now, let's look at total liabilities. So this company's total liabilities is 11.6%. Remember, the way we calculated that is we took 384 divided by the base amount, which is either total assets, or you can think of it as total liabilities and equity. So suppose the average company has total liabilities that make up 41% of total assets. How does this company compare if they have 11.6% total liabilities? Well, that means this company has very little debt. But what if the industry average was 12%? Now remember, the industry average, when you compare your company to the industry, you're comparing it to companies in the same industry. In other words, companies that are very similar. Well, if the industry average was 12%, and this company's average is 11.6% for total liabilities, then it's about average. It's not a big difference.